have. Thanks again.
Thank you, James. And with that, I'm going to turn it over to my colleague, Christopher Coase, to kick us off. Christopher? Can you hear us, Christopher? Okay. Christopher, are you able to hear us? All right. Well, while we give Christopher a chance to get his audio working, I wanted to give our two speakers a chance to introduce themselves. Today, we're joined by two smart growth financing experts. First, we're joined by Brent Parker, who's a principal at Novogradac, and Michael Rodriguez, who is the director of research at Smart Growth America, as well as a market lead at CBRE. So I will give them both a chance to introduce themselves before kicking it back over to Christopher to get us started. Brent?
Sure. Just happy to be here, and thank you all for inviting me and letting me be a part of this process. I'm a principal at Novogradac Company. We are, a nationwide firm that focuses on tax incentivized, investments such as Opportunity Zone Incentive. I'm sure a lot of you guys know who we are. But I myself do, consulting, models and projections and forecasts, also, audited financial statements, tax returns, agreed upon procedures, and all that fun stuff. Been with the firm for about 15 years, and that's about the gist of it for me. But I think it's a great to be here today, and thank you very much.
Thank you, Brent. Michael? You're mute. Oh.
Hi, Michael Rodriguez. I'm Director of Research at Smart Growth America. Just about 5 years now. I oversee a lot of the research programs that we do, including fiscal impact and economic impact analysis with our economic development team. I also worked in the consulting rounds for urban planning, transportation stuff, and more recently in the commercial real estate field with CBRE, where I last was. And yeah, that's my background, and very interested to talk to you guys.
Thank you, Michael. And with that, Christopher, are we able to see and hear you?
Yes, it's really weird. I saw James chatting, and I was like, man, I just really can't hear him. He's really going in, and then I realized, wait, it's me. So again, good afternoon, everyone. It's good to see you, Todd. Good to see you, James, and Michael, and so many others, familiar faces. Again, I'm Christopher Coase. I currently serve as Vice President at America, along with Tola. We are managing the National Opportunity Zone Academy TA with the city of Pittsburgh. But before we get into the academy, just for those who this is your first time interacting with Smart Growth America. Smart Growth America is a national nonprofit based in Washington, D.C., although now, I guess we're like everyone, we're all teleworking, so our staff are everywhere now. But based in Washington, D.C., and we really have a simple ethos and mission statement that we envision a country where no matter who you are, where you live, you should be able to enjoy a place that's healthy, prosperous, resilient. We know in time and time again the value of place, how place can be a social determinant for health, for economic prosperity, as well as mobility. And our work, as you've heard from my colleague, Michael Rodriguez, through economic development, through land use development, through transportation policy, as well as working in human capital through our Dartmouth community programs, we really try to create this holistic intersectional approach to achieve this mission statement. One of the key elements of our work, in addition to managing our land use development team, one of our programs, LOCUS specifically, is one of the national coalitions that's been really a leader in responsible real estate and investment. You may know many of our members. I know locally we've worked very closely with McCord and Baron Salazar. I know who's been doing a lot of work downtown and throughout the region. We've worked for firms like formerly known as Forest City, Cherokee Investments, and many others who I know have done many projects around the region. But more importantly, we really kind of use those who are the good guys, those who understand not only you have to make a buck in real estate, but understand that you have to do it in a way that actually improves the outcomes in the community. Also recognizing that when we build, how we build matters to the planet. And so in many ways, our members are really on the front lines of trying to create truly inclusive, resilient, and equitable communities. So through that partnership, we have really worked with a lot of our members and stakeholders across the country to really ask ourselves a fundamental question. How do we really use this tax incentive opportunity zones in a way that meets that ethos? One of the things last year in 2019, wow, it's really interesting when I say that, like that was just last year. I feel like that was so long ago. But in 2019, working a partnership with Rockefeller Foundation, we launched a 67 city academy, recognizing that when the Opportunity Zone tax incentive was released in 2017, a lot of mayors, a lot of community stakeholders, even those in the real estate community, even those within the philanthropy, really recognized that we needed more capacity to figure out how we could create these partnerships, how to do it the right way, given the fact that the federal government didn't really give much direction. It's basically like, here you go, now go forth. And so we really try to use this opportunity to bring the private sector, the city and policymakers, as well as the stakeholders on the ground, to really make sure that the ecosystem that we're working with, this in the real estate community, in the small business entrepreneurship ecosystems, make sure we're driving equitable change and equitable outcomes. So one of the things that, as I said before, we got in this space really to make sure that Opportunity Zones really achieved what we believe as a net positive for the residents and the businesses. But a lot of this is based on a lot of research that our team, as well as Michael and many others, have done for the last 10 years, is really understanding about the marketplace. And you're going to hear today not only a top-line discussion about Opportunity Zones, not only what we're seeing in terms of the transactions, but also where the market is going. And hopefully, not only since this is the kickoff, a series of conversations over the next several weeks on how you, Pittsburgh, and the broader region can really make sure not just your Opportunity Zones, but your larger revitalization plans in these communities are achieving those gains. And one of the things I'm going to talk about in a second is that we did a lot of work as an organization, really understanding some of the pressure points, the tensions in achieving equitable development. And also, one of the claim of fame, back in 2018, once the Opportunity Zones were finalized, we actually, working in partnership with George Washington University, analyzed every Opportunity Zone based on an economic performance as well as a social equity performance. And through that work, based on a lot of literature, we learned a couple of things. Well, actually, you can go back one more slide, Tola, thank you. We learned a couple of things. One, through the research and through our conversations, not only through the academy that we are doing with Rockefeller, as well as some academy in Massachusetts, and through some of our technical assistants, we recognize that one thing is true. Now, all Opportunity Zones are not created equally, okay? We recognize through a lot of surveys that we've done with investors and project sponsors that communities that are giving a clear guidance on what they want to do in these zones are places where people would like to go. Particularly, you hear this a lot in community development or trying to attract capital. The least resistance, does your zoning, does your regulatory processes align with your vision? I can't emphasize this enough, and I know Brent and Michael will echo this in their presentation, so I won't hit the hammer too hard or steal their thunder, but opportunity zones don't make bad deals good, right? You've heard that over and over again. And so communities, as well as stakeholders at the federal and state level who can align the necessary gap funding to make these deals actually pencil, therefore be more attractive, is crucial. Beyond that, we also have learned through the research and through some of the analytics that we've done recently that development is happening in places that are encouraging infill, multifamily coordination. So let's go to the next slide. Thank you, Tola. One of the things I want to emphasize here as we think about opportunity zones, based on our classification, as I mentioned before, all 8,700 opportunity zones are not created equally. When we look at the market, we clearly know that there's a pent-up demand for live, work, play environments, places that have great accessibility to jobs, great accessibility to parks, particularly in COVID-19, great accessibility to healthcare facilities, right? Those places we are seeing in the marketplace with a pent-up demand that has not been satisfied. And because of that, we were able to identify opportunity zones based on where the market is going, based on the pent-up demand in the top 30 metros across our 8,700 opportunity zones. And of course, this just kind of gives you the type of opportunity zones that are out there. Large sum of the opportunity zones are actually in that bottom what we call potential walkable urban places. No one wants to be called non-existent. Everyone has the potential of being a great inclusive walkable urban place, but a majority of actually opportunity zones are there. Based on our calculation, over 96% of opportunity zones are places that individuals are spending more than 50% of their household income on housing and transportation. They are more than 20 miles away from job concentration, things of that nature. And so in many ways, these are places where the market, unless there's major policy and infrastructure retrofitting, opportunity zone capital is not going to be the leader. However, what we did find in the remaining 10% of the opportunity zones, whether they're emerging or already established walkable urban places, this is where the market is going. So now if we go to the next slide, this just gives you a snapshot of how it basically breaks down by population. So if you can see in the lower left-hand corner, the places that are what we call low smart growth potential, low social equity. These are places, again, where people are spending more than 50% of their household income on housing and transportation, are further away from transit options, further away from jobs, and oftentimes have some of the highest disparities that we see in the community based on the built environment. Where we are seeing most of the opportunity is everything above in that high social equity, high smart growth communities. Those are places that we knew are changing, but that top left-hand corner is actually where a lot of conversation has been happening, where you, with the right policy, with the right economic development strategy, you can move those communities for not just being great in terms of affordability, in terms of access, but actually can become even higher wealthy producing communities. Now, the challenge is, can we ensure that those communities in that top left-hand corner moves horizontally, literally across, which means you're not displacing existing residents, you're not displacing existing businesses, but if that top left-hand corner goes diagonally to that bottom right-hand corner, that's what we're trying to prevent, and that's what this academy is all about. Next slide. So if we talk about what's happening in Pittsburgh, this is one of the things that both from my team's perspective, but also as we talk to both Tom and James and others outside the region, Pittsburgh should be excited. You guys did a couple of things right. First and foremost, as you can see here, a large swath of opportunity zones in the Pittsburgh region are by far some of the top in the state. A lot of your opportunity zones, as you can see, the blue are the opportunity zones in the state of Pennsylvania, and those are kind of in like a burgundy red are actually the Pittsburgh. And so when you see how your opportunity zone compares to other opportunity zones in the state, you can see a large significant portion of your zones are in places where people are spending less than 45% of household income, have general good access to certain transportation and job access, but these are the places, these are the neighborhoods that once you start making major investments in economic development are more likely, right, to gentrify. And the question here is, do they gentrify in a way that's inclusive and equitable, or do they do it in a way that gentrifies and actually leads to displacement? And so you see here, Hill District, see your downtown area, Fine View are definitely in those places where I would suggest to you, now is the time to have this conversation, especially now as we, knock on wood, come out the tunnel of COVID-19 as the market begins to reignite. Next slide. So again, as I said, the purpose of this academy is to think about the tools, the processes, the innovations we can potentially create to make sure that your opportunity zones are not necessarily sliding diagonally, by actually going to that top right-hand corner, which is truly inclusive, resilient, and prosperous walkable urban neighborhoods. So from that standpoint, next slide. So here's what this academy is going to provide over the next several weeks. One, we're going to have a series of discussions, these roundtables. I think, correct me if I'm wrong, Tola, it's every other week, same time, same place, right?
So it's a little popcorn style, but folks should have the schedule in December and January. We'll be doing these.
Yeah. And then from there, these conversations will be on a range of topics that has been selected not only by James and Tom, but also based on the conversation we'll be having throughout the next several weeks, bringing experts not only locally, but actually nationally to advise you on how to develop your opportunity zone strategy, or actually make sure that your business are taking advantage of it in a way that, again, achieves that North Star that I mentioned before. Which we'll do after those conversations. We'll then be working with James and Tom to help create their OZ strategy. And of course, we're trying to be dynamic because the market is constantly changing. So with that, once we've done that, identify the strategy, and particularly identify key projects, working with our national network of real estate developers and investors, as well as regionally investors and developers, we'll be hosting, hopefully in person, but if not, we'll do it on GoToMeeting or Zoom, some link ups, some business development opportunities. So with that, I think it's very good to just stop right here to see if there are any questions before we begin to get into the meat of the discussion today.
Sorry, one quick question. This is Krish Pandya from Oak Moss. Just out of curiosity, where does Hazelwood sit in that map or that quadrant matrix that you showed?
Name the neighborhood again. Sorry.
Hazelwood.
Hazelwood.
1-5.
I do. So before my presentation is done, I will have my colleague Tola to actually come back and highlight that for us. I don't have it off the top of my head. I would definitely go back into our notes to figure that out and put that in the chat box. But thank you for that question.
No worries. Thank you.
Mm-hmm. Anyone else? Okay. So here is, as I said, we gave you the kind of the top line of where the opportunity zones sit in terms of the marketplace of what we've known for a while. But it's really fascinating. It's still, despite a tax incentive that's been around now almost for 2 years, a lot of people actually still don't know anything about opportunity zones. And so for those of you who have been who are not aware of opportunity zones, what I'm going to do is for the next 3 minutes, just give a very top line introduction. I definitely will say that we have tons of informational material that we can share offline as part of this roundtable discussion for those who want to go even deeper. Also, Brent and Michael will be providing even more industry-specific details or project-specific details. So for the sake of this conversation, I'm going to keep it very high level, but if you have specific questions, please feel free to type it into the chat box, or as well ask myself, Brett, or Michael as we go through our presentation. So let's talk about this real quick. So for those who don't know opportunity zones, here's a 3-minute top line update. So opportunity zones, what is it? Okay, turns out opportunity zones is a conversation that started in 2015 as a response to the fact that many communities, rural, the Midwest, industrial Midwest, communities were not seeing the same level of economic recovery as some of the major markets. Okay, that's number one. Sentence minute number two. As such, as those of you who already know, whether it's at the local level, at the state level, or the federal level, we always hear we don't have any more money. We don't have any more money for community benefit, for CDBG dollars. We don't have any more money for community development dollars. We're not increasing any of these tax credits, right? So there's no more money. That's the claim we hear at all forms of government. In recognition of that, the question on the table was, where is the existing capital that could be diverted to support the revitalization, the economic recovery in the communities that were not experiencing it as some of those major markets? The top line here is that actually a lot of the conversation was around, at that point, about $6 to $8 trillion of opportunity of unrealized capital gains existed in the general marketplaces. So if you think about Silicon Valley, the tech world, or Wall Street, or even regionally, corporations that may have land holdings or business enterprises that they're selling off, or family offices or philanthropy, who have all these unrealized assets. Think about, Michael Rodriguez, turned out and invested in Google, and now because he's really, really smart, that's why he's the director of research, his evaluation went up to $1 million of unrealized capital gains. He doesn't want to pay tax on that $1 million, right, Michael? Nodding your head. Yep, exactly. So the general thesis here, for those individuals with those unrealized capital gains who are clearly making current investment in whether it's the stock market or within tech and startups, let's convince them to move those dollars into these distressed communities. So the government, the federal government, allowed governors across the country to select up to 20% of their low-income census tracts for these dollars to flow into. Now, how does one invest in an opportunity zone, which is a geographical place? Well, Michael Rodriguez, with his $1 million of unrealized capital gain, will sell that gain. So he sold his Google stock the other day, or Amazon stock. I guess that would be the more appropriate for you, since that's right down the street from your house, Michael. He sells it. He creates what is called an opportunity fund. And that is simply a corporation, investment holding. Now, that corporation, self-certified, is allowed to invest in a couple of things. It can invest in real estate, it can invest in operating businesses, or it can invest in partnerships that does one of those two. The key distinction from this particular tax incentive and structure than a lot of the community development programs that we talk about a lot, like CDBG or home or historic or low-income housing tax credit, is that these funds are dealt with in equity. They do not do debt, right? So basically, the funds that come into these funds that Michael is now putting in this opportunity fund, he has to go buy property. He has to have ownership in operating businesses and things of that nature. Now, of course, why would Michael do that? Well, essentially, the tax incentive provides him three basic benefits. One, a tax deferral, so he doesn't have to pay any taxes on that $1 million until 2026. So that's a good benefit, but maybe that isn't exciting, right? The second benefit is the fact that it allows you, because the idea is to get Michael to invest early and soon, is that he gets a reduction on his tax liability on that $1 million. So instead of, if he gets in by 7 years, which was last year, his tax liability at $1 million at 226 will go down 15%. So that says he has a tax liability of $850,000. If he gets in at least by 5 years before 2026, his tax liability goes down to 10%. So his taxes go down on initial investment. Now, Michael, nod your head. That sounds good, but that's not really, you're not going to change your investment strategy. No, actually, the big claim of theme of this investment is the fact that not only do we want Michael to invest soon in these distressed communities, but we want him to stay in his investments in those communities for a long period of time. And the kicker here is if Michael takes his $1 million and invests in mixed income development and some startups and opportunity zones or some operating businesses, and he makes some money. Let's say he doubled his investments to $2 million. Man, Michael, he was so smart with his investment. The federal government essentially says that additional increment, that additional $1 million increment is now tax-free. That's the ball game. So hopefully, I know I'm talking to a lot of folks in the real estate space, in the community development space. Hopefully that was a good overview. We're going to get into some specifics, but that's the baseline. Now, the key thing here is it's not a program and it's not free money, right? It's essentially changing existing investment behaviors So investors who were not in these communities before or who are in these communities are now looking for market-ready projects to move forward. All right, let's go to the next slide. Now, this gives you a snapshot of the current investment timeline. I know it's like a 2-second delay. Thanks, Tola. And again, I just want to say again to Tola, who's organizing this call, thank you so much. She's been such a rock star. So I just want to give you a quick shout out. This is a snapshot of the timeline. The two big takeaways here, again, is 226. Everyone has to pay their tax. So literally in about 5 years and 5 years and 11 months, folks will have to pay their tax. So you're going to see a lot more interest in terms of it. Also, 2028 is the last date, December 31st of 2028 is the last date that an investor can invest in one of these opportunity zone qualified transactions. The key thing here, though, is by 2047 is when most investors have to unwind. And why is that key? Because at the end of the day, the benefit of the tax incentive itself is to find projects that appreciate. So now you begin to see that there's a project selection criteria even embedded in the timeline. So again, as you see the timeline going, yes, you have a lot of time, people go in, but the question is there has to be an exit strategy because that's the whole purpose of the tax incentive. Okay, next slide. I'm not going to go into this really deep, but of course, due to COVID-19, there's been some extensions, some more flexibility. I know Brett is going to get into that a little bit more about some of the projects that he's working on, so we'll skip that for a second. But what I'm going to end on my last couple comments on opportunity zones, what we're seeing is the marketplace. So right now, what we know is here's some of the typical projects you see out there: affordable housing, infrastructure, particularly green, solar, energy infrastructure. Initial investments in commercial real estate pre-COVID. There's a conversation about whether those transactions are happening during COVID. We're seeing a lot of interest in TOD transactions. There are a number that we've been working on or been advising on. There's this conversation about small business retention, particularly around incubator spaces. Some other projects that we're seeing, opportunity zones, opportunity funds invest in, include manufacturing. I think actually that's one of the best-selling stories now in COVID-19, that we're actually seeing a lot of interest in acquisition of industrial and manufacturing spaces. And I know that is something that this group in Pittsburgh would be really interested in figuring out how to harness. Before COVID-19, hospitality was one that was emerging, but as you can imagine, hospitality has been now one of those everyone kind of stayed away. But I will say there's interest about doing hospitality conversions to apartments or to short-term residential living. So there's a conversation around there. So this gives you a snapshot of some of the type of deals that are out there. I'll be honest with you, one of the things that we have recognized, if you go to the next slide, Tola, is that we just did a report working with our friends at on the economic development team at Smart Growth America, where we actually analyzed and interviewed a number of opportunity funds as it pertains to minority legacy businesses. And I'll just be honest with you, that's been one of the weak links in the discussion around opportunity zones and opportunity funds specifically in terms of businesses, but particularly minority legacy businesses. And increasingly, I think it's just one of the things I just needed to put out there and just like have true serve. If you care about this, if this is a priority, then a lot of the activity has to be city, if not state-led, and community development-led. But again, this is to show that there's a lot of funds out there that were created in the last 2 years. Go to the next slide. And in terms of volume, on an annual basis, the federal government spends about $7 to $8 billion in the low-income housing tax credit. Just in the year and a half that Opportunity Zone Marketplace, and almost in a year, over $75 billion with a B have been raised and have been deployed. Now, if you track the projects that you kind of knew they're already out there, they were already going to be moving forward, that number goes down to about $50 billion. Every year, the federal government spends $7 to $8 billion just on the low-income housing tax credit program. In less than a year, we raised $50 billion going to low-income census tracts. Now, whether you like the program or think it's great or not, just the sheer volume impact is real and we can't ignore it. And one of the things that we have an opportunity in terms of the conversation is that the capital, because of the way it's been designed, the way some of the inertia of the regs coming out, really is favoring multifamily housing. And I know a lot of the conversation we've been having with James and Tom before is the fact that how do we create more affordable mixed income housing development in around some of the transportation nodes is going to be key. We'll go to the next slide. Again, as I said before, one of the bright spots during COVID specifically is industrial spaces. And I just want to call this out because Pittsburgh, you have a lot of this. You have a lot of manufacturing spaces in and around the city and the region that are within your opportunity zones. And I definitely want to call out that as this is a good place to definitely think about what your long-term strategy is for that product type. All right. So to close out, there's basically two things I want to leave you with. Number one, if there have been a lot of conversation of folks saying, opportunity zones, am I too late? COVID, is this for me? I'm letting you know right now, there are going to be multiple waves of opportunity zone, opportunity fund investments. So the fact that you're starting now is actually not a bad thing. It's actually perfect timing because the world's going to look different post-COVID. And now is a great time to be thinking about how to position Pittsburgh in this new reality. Second advice I can give you, next slide. And this is the one that I want to be frankly honest with you. One of the best ways to be successful in opportunity zones, one of the best ways to assure that the projects that you're trying to deliver, whether it's for a community benefit, whether it's for private sector interest, whatever, it has to come back down to understanding the project gap. No opportunity zone transaction, Brent, correct me if I'm wrong, but no project is out there, opportunity zone in and of itself, the fund itself is closing existing project gaps. It really is forcing states, localities, and non-traditional
Is Christopher frozen for anyone else?
stakeholders to come and create these partnerships to actually make these deals move forward. And to who can provide even more.
Yes, he is on my end as
Oh,
well.
sorry. Did my internet go out?
Yeah, you broke up a little bit, Christopher, but
Okay. Am I back?
yes.
So the bottom line here is it's all about the gap. And so one of the things I would say here is I would like to turn it over to Brent and Michael, who are going to provide a little more greater detail in terms of how some of these projects are transactions. So with that, I'll turn it over.
I'm going to quickly, before Brent and Michael jump in, I wanted to give James and the Urban Redevelopment Authority a chance to quickly ground us in the Pittsburgh context and give us a little bit of background on their work to date around OZs, the city's vision, and thoughts on the future of OZ activity in the city. So, James?
Thanks, Tola. So I think the biggest thing to keep in mind when the URA is really approaching its opportunity zone work is trying to understand this from an ecosystem perspective. We have numerous stakeholders, whether it be community development corporations or other organizations, financial partners, local government, etc. And all of those different entities are going to play a vital role in making sure that the opportunity zone activity that is attracted to Pittsburgh is really in line and consistent with the spirit of the opportunity zone law. And what we really want to see through our work with Smart Growth Academy and the Rockefeller Foundation is the development of strategies and policies to ground these efforts and investments in equitable economic development, and especially in a number of our neighborhoods that have been historically disinvested. And so the cohort that we have in this group today is really some of those folks who are taking on those redevelopment projects either through URA's pipeline or are interested moving forward on the work that's going to be done in the avenues of hope. And many of the avenues of hope are also, in opportunity zones. And so, ultimately where we're going with the smart growth work is to develop that framework and then strategies to ensure that we have good OZ investments that can really result in quality project growth that benefits communities. And the second thing that we are also working on at the URA is really trying to attract larger impact investment, as those types of entities are more likely to want to pursue mission-driven opportunities. And we are currently in the process of working through an RFP with one impact investor in particular, and are hoping that that goes well, because it would result in a significant amount of OZ equity and that would be able to be invested in all of these different projects in Pittsburgh.
Great. Thank you so much, James. Now that we sort of know where we are and where we'd like to go, I'd like to turn it over to Brent to dive into the nitty-gritty of OZs.
All right, everyone. Well, thank you for setting the stage. That was great. I think responsible stewardship is critical for the successful deployment of investments in your community, and making sure that it's sort of going the direction that that you intend. Is super important. So a lot of communities, haven't embraced the incentives the way that maybe they should, and those that have been pretty successful already. So we're looking forward to seeing a lot more communities sort of get into the swing of things here and figure out how they want to use the incentive, because it is so flexible and you can use it in so many different ways. So what I'm going to do is I'm going to talk first a little bit about sort of some of the structuring and concepts that lead into a discussion about capital stacks and things of that nature. And I think as we were sort of discussing and looking at here, we there are gaps potentially depending on the type of project you're doing, and and what the need is and what the incentives available are. But that really depends on really what you're doing, what you intend to sort of develop, and how that's going to be financed. So we'll kind of get into that a little bit. Feel free to jump in with any discussion or questions or anything like that. So first, just to sort of do a quick overview on the structure of a typical sort of OZ investment. You have investors, and we got some of the basics already, and so I apologize if there's some of you that are really super familiar with the incentive, but some of this is going to be basics. So there's investors. Investors need to make their sort of qualified investments within their 180 days. We're not going to get into the detail of what the 180 days is and all that, but just suffice it to say that that they have that sort of limited time frame to make their investment into the QOF or fund, Qualified Opportunity Fund. That entity needs to be a partnership or a corporation, typically going to be a partnership, or an LLC, a multiple member LLC, and it will have a sponsor, which is sort of the general partner in the slide, and then the general partner, and then the QOF is going to invest those proceeds, and it has testing dates, right? So it has it's required to sort of meet certain thresholds at certain testing dates, and it has it has a period of time sort of make the investment without getting penalized, but it has to timely make sort of investments into the lower tier business entities. So this is then a separate entity or separate partnership or corporation. Typically, again, going to be a partnership, especially real estate oriented projects. But the beauty of this is that you can have operating businesses that that could take any number of forms. You could have you could have tech startup businesses or anything really. You just kind of have to make sure that it's structured correctly and that you're meeting all of those tests applicable to, you know, the respective businesses. But that's why here we're sort of showing operating businesses. I think there was a slide before that discussed, you know, or that showed what the breakout of operating businesses it was. I'm just going to go back to that really quickly because I thought that was a pretty cool slide. And it's pretty small here. So obviously there's not a huge amount of operating business activity yet, but largely, you know, the operating business aspect was sort of unknown if you could even really do it successfully prior to final regulations. You know, there's a few changes in there that allow you to sort of use working capital toward, you know, these operating businesses and things of that nature. So, you know, hopefully we'll see that increase because, you know, as some of these players get into it, you can just imagine some of the returns that you can get on those operating businesses that are, you know, 10x, 20x, who knows? You know, if one of these ends up being a unicorn or something like that. I mean, it could be, you know, unending. But at this point, we see a lot of real estate because that's known. It's you know, you can definitely do it. It's just a matter of sort of what you are trying to produce, whether it be workforce housing or market rate, you know, multifamily or, you know, affordable housing. So that's sort of the tools that we're going to talk about more so. But in any event, getting back to the main part of the subject, I think there's a lot you can do here, but you're going to see these two tiers typically. You know, a QAF can invest directly in property, but there's reasons why it wouldn't, because of sort of working capital conditions and, you know, a longer period of time to start up a business. So there's a lot of, so what we're going to see, I think, with respect to, or what we do see with respect to municipalities and that own land and things of that nature is, you know, sort of a ground lease structure oftentimes, right? And so, you know, if there's land that's sort of, you know, owned or held by the municipality, can set up this, you know, ground lease to the opportunity zone business. And then opportunity zone business develops that property and sort of subleases it out under this sort of regular structure. You know, and the benefit of that is obviously, you know, you can sort of impose some of these restrictions and things like that. So we can see, you know, we can see that there's, you know, hopefully going to be able to partner with some of these community-minded folks that are willing to put a certain amount of affordable housing or something like that into the structure. And so I was going to talk a little bit about like 80-20 deals and master lease deals and things of that nature, where potentially you're able to sort of partner with a developer that has a portion of this in mind for, you know, for various incentives. So I did want to talk about some of the sort of developer issues because, you know, I think the most difficult part in all of this, in my mind, is hooking up, is connecting the developers, educating the developers, and, you know, and connecting those parties with the funds effectively in the way that you want it to, you know, occur, and the right parties that you know are going to sort of develop your city in the way that you sort of foresee it. You know, and these developers, a lot of them just don't really have the education, obviously, and the incentive. You know, there's a lot of funds out there that are looking for investment, and there's fund listings. For instance, on our website we have a fund listing, and there's a lot of other great websites that have fund listings. And I was checking them this morning, and there's a lot of funds that are looking for investment in Pennsylvania. But you know, but the issue is really being able to sort of educate and get the right developers and the right, you know, community sort of contractors and whatnot, you know, in line with the incentive and understand it and be able to sort of navigate the issues, because you know, the ability for that business to qualify under the incentive really is critical to the fund. I mean, there's, you know, all these sort of requirements that the business level in that sort of multi-tier structure has to meet. You know, and they can be complicated and confusing. So, you know, I mean, one of them, for instance, is non-qualified financial property. Non-qualified financial property sort of means that you have to effectively manage your cash. You can't sit on cash. You have to, you know, be distributed and things of that nature. And you have to watch out for what types of leases you're entering into. There's all types of issues there. But some of the bigger developer issues, and I think that as you guys progress here, you know, and you're sort of, you know, putting the parties together and creating these transactions or helping facilitate these transactions, you know, I think it would help to sort of be educating these developers and all that in this manner. But some of the complexities that we see are, number one, you know, navigating that development timeline. So, you know, you have a certain period of time, right? So once the cash, and this is a little bit different from your typical sort of like LIHTC investment or something like that, where you have cash that comes in sort of phase. You have a construction loan. Construction loan is drawn down, and then you have sort of installments of equity that come in as the project sort of matures and is, you know, placed into service. You know, with the opportunity zone incentive, you sort of need the cash to get. I mean, the investors sort of need the cash to get in. You could have multiple installments, but typically there's going to be cash. Cash is going to be installed, and then you're going to have this sort of 31-month working capital timeline to sort of develop the project. And if the project's a bigger project and it's going to take longer, you know, you could have up to 62 months, but you really have to structure it correctly so that you're able to maximize that timeline. So developing in the correct amount of time in the right way becomes really important. You know, these parties need to have like these schedules, these working capital schedules that have information laid out in there as to how they're going to sort of, you know, do this construction process and what benchmarks they're going to meet and all that documentation. So it's also very important that partnerships or alliances are made between, you know, the right sort of tax professionals and attorneys. So, you know, I work with a number of attorneys that you know are very knowledgeable in this, and there's a lot of attorneys and tax professionals that would like to say they're knowledgeable in this, but they're not. So I would say also be careful about that. But in any event, there's a lot of requirements for this sort of development of the project that you have to deal with up front. So having the developer understand those becomes important. Like I said, cash management. So this non-qualified financial property condition, you're only allowed to have, you know, less than 5% of the unadjusted basis of your assets be this sort of excess cash or whatever. And that's considered working capital. And so if that's considered non-qualified financial property, sorry. So, but if it's considered working capital, then that's a carve out. So like what is working capital and you know, and so developers need to sort of understand this, I think, but you know, a couple of months of expenses may be considered reasonable, but more than that, not, you know, and then you have these strategic sort of testing dates at the middle of the year and the end of the year, so those become important. So that's a big issue, cash management. You know, and then circular cash flow. So this is a big topic put into one line here. So you have a lot of developers, a lot of people that are going to say, you know, I have some property, I want to develop this. How do I do this? And the issue is so there's a couple of different issues there. One being that you have the property, in order to qualify as qualified opportunity zone business property, has to have been acquired after 2017 from an unrelated party. So if developer has land and they want to develop land with the help of a fund, but they want to have an ownership stake in that entity, obviously, that owns the land, and ultimately maybe at some point cash out the investor, then then they're going to have to somehow get that land into the project, into the Quasby, and if they plan on, or if they're going to own more than 20% of that entity, then there's potentially number one, a related party transaction where that transaction, if it's a sale, would not qualify as good property. Number two, if they plan to sort of invest in this thing, and there's a potential circular cash issue there, which could kind of blow up the whole deal. So that whole issue, there's ways to deal with this, potentially to do a lease. You can have related party leases and things of that nature, but that's a very complex topic. And if it's a property that's already in use and they plan on sort of substantially develop or improving that property, and it's going to be bad property that's acquired in this related party transaction, then that really could also blow up the deal too, because there's no way to really substantially improve property that doesn't qualify. Land itself, if it's just land, you can build on that land, and the improvements upon the land are considered separate property. So that land could be bad property and the entity still qualify if the land is within that sort of bad 30%. On the 70% test. And I'm sorry for those of you who don't know what the 70% test is, but I think most of you do. So lease issues, again, if you do enter, if there is a lease and it's decided that there needs to be this sort of lease, then making sure that that lease isn't considered a financing lease for tax purposes. So if there's really a majority of the economics or life that's transferred, or it transfers as a function of the lease ownership, then that could be considered sort of an acquisition. So if developers trying to avoid some of those related party issues, or even if there's a lease with the municipality or whatever, there may be issues there. And other conditions on the lease. Be aware of leases that have like large prepayments or changes in increases or decreases in payments that are not sort of tacked to an index or something. That those can trigger what's called a 467 lease. And what happens there is, now you had an operating lease that sort of works under the opportunity zone incentive because the operating lease is considered good property. But what would happen is, if then it's considered, if there was like a large prepayment from the Quasby to the lessor, then that might trigger a portion of this lease to be considered a loan receivable for tax purposes. Which then all of a sudden it becomes non-qualified financial property. So make sure you understand, the tax implications of leases and things like that you're going to set up, because that becomes really important. So I think that's it for that. I beat that to death. Let's see. So a couple examples here, I think, how the incentive is being embraced, and it really is being used so differently in many different areas, and that goes back to the zones or the tracts that were even established and designated. So when the tracts are sort of designated by the governors, for example, in Illinois, largely used for urban revitalization. In Colorado, largely used for rural. But it just depends on what the need is for that state. But there's ways that now the tracts have been sort of established, right? There's some question about what might happen with contiguous tracts, but that's something like 5%. So we'll not talk about that. But now that the tracts are sort of established, we're seeing what these communities are doing with the incentive, and it's pretty exciting. In Erie, Pennsylvania, down the street from you guys, I guess. It's within the state anyway. You know, they're really embracing the opportunity zone incentive, which I think like Pittsburgh is as well, it seems like here. And the local support is really behind these community revitalization projects and real estate projects. So there's a lot of that that's going up, a lot of support for it, and you know, things are, the zoning is coming along, and a lot of good projects are sort of coming up. There are also local incentives in Erie, Pennsylvania. So I think that's sort of a good example of a successful area. In St. Louis, you know, also embracing, but using it for, you know, for different purposes, for, you know, business sort of creation, job creation, you know, municipality support. So that's you know, also real estate driven, but focusing on sort of creating jobs and creating businesses, operating businesses. And they also have developed a local incentive, a sales tax rebate. There's a lot of incentives out there for, you know, for opportunity zone developers and opportunity zone projects where they can qualify for certain things a lot easier, which I think is a great tool. Also, not on the slide, but I want to mention a few funds that are doing different things here. And I know, I mean, maybe you guys have heard about this one. I haven't worked with them, but TPP, I guess, Real Estate Development Fund. It is a pretty interesting fund that's in Philadelphia, and you know, they're sort of raising funds. It's I think they're raising like 300 million for, you know, a really like a neighborhood revitalization, and they're basically looking to, I think, develop like 172,000 square foot area to put in, you know, a whole bunch of affordable housing units, like 500 affordable housing units. Also, you know, a good amount of market rate units, maybe something like that for market rate units, senior units, you know, multi community resource centers, and you know, food hubs, and you know, all of that stuff. So I definitely urge you guys to take a look at what they're doing. It looks pretty interesting. I don't know how successful they've been so far on raising capital, but their strategy and approach and what they want to do looks pretty interesting to me. So I would take a look at that. You know, and then there's a fund that I work with. So let me get into let me see, let me finish the structure conversation, then we'll get into talking about sort of pairing with low-income housing tax credits and things like that. And I'll give you a couple more examples. So it's the structure of a fund. So we already looked at a structure chart, so I'm not going to beat these up too much. But when we're talking about funds, I think we, you know, and pairing credits and things of that nature, we sort of need to understand how these structures might be set up. And so, you know, most funds I think are set up as single asset funds. So investors invest in QAF invests in business acquires and develops land, or leases and develops land, or other project, you know, in-use projects. And you know, then they set up, you know, another fund for a second asset, etc. You also have some of these funds that have multiple investments in businesses, and you know, I actually have a few clients that are, you know, large clients that have done this, and they're developing sort of all over the country, depending on sort of what works for them, and it's diversifying some of the investment risk, you know, at the same time sort of allowing them to have this sort of critical volume. But you know, there's risk factors with this. So you know, if you have a bad investment for the QAF, then it might sort of become a larger penalty base. So that's an issue. And then a third structure is the sort of single QASB structure, but then the QASB invests into lower tier single member LLCs, which are disregarded. If those entities were considered to be separately regarded entities, then they would be the business's ownership interest in those entities would be considered non-qualified financial property. So in this case, it's effectively for tax purposes as if the business owns multiple properties. I think it's just important to sort of understand that stuff as you're helping people navigate, some of these rules and set up their own structures. But ultimately, you would sort of entertain these different structures depending on potential risk. There might be a project that is going to take up 20% of the capital coming through the fund structure, and it's sort of a risky project, and we're not sure that we can meet compliance. We can meet the OZ compliance on that, and if so, you might set it up under this third structure where there are single member LLC businesses under this, one business. What happens there is that even if sort of that the one single member LLC owned bad 20% business doesn't sort of qualify, then that is aggregated with the other business, and just if we're looking at just the 70% test, you have 20% bad assets, as opposed to if either of the other two structures are used and there was separate fund structure or the fund with multiple quasbis, then you wouldn't be passing the 90% test at the fund level, at least for one fund or for a portion of that multiple quasbi funds. So just understand that there's different ways of doing this, and it's important to understand that stuff. So moving on, let's see, I'll make sure I'm not infringing on time. Let me know if I'm being too long-winded here. So the investment market, Tola, were you going to say something? Or?
No, I'm going to jump in after this slide.
Okay, great. So the investment market out there is pretty interesting. I mean, there's a couple of different ways that proceeds are being invested into communities. Number one, through open funds, which we have sort of a better understanding of. These are typically being there's some reporting going on, and in these funds they raise proceeds for a particular asset or assets, solicit investors, and there's maybe an estimated 75 billion deployed from these funds, which I think was a number that was thrown up earlier as well. So that's pretty impressive, and those are what we sort of understand and know about. There's also these closed family funds, which utilize their existing proceeds, so internal sort of capital gains proceeds, but seek assets. So there's a lot of assets out there. There's a lot of opportunities sort of invest in communities. Obviously, there's a lot of development need, and some of these closed funds, we don't really know to what extent. I mean, we know that what the IRS has told us and things of that nature, but there's a lot of these closed funds that are starting up and looking for assets. So I think that's a potential good source as well. But unfortunately, we don't really know what the assets or the deployed funds are really at this point. But that should be growing as well. So I think we're going to see a lot of movement there. All right.
Let's.
Is that it for me? Sorry, Tola, is that it for me, or?
One more round of slides, Brent. But before we move on, I wanted to take a pause and give folks in the audience a chance to. Thank you, Brent. First, I should thank you for that.
Thank you.
Does anyone have any questions for Brent? I know he's gone through a lot of pretty detailed information, so we want to make sure that folks are understanding the information, asking clarifying questions.
Yes, I have a question.
Mm-hmm. Yep.
So, Brent, you mentioned you were just talking about the structure, the 80-20 structure early on in the presentation, where 80% of the profit would go to the investor, 20% to the sponsor. Is that just for a certain time period, like during the 10-year opportunity zone period, or is it longer than that?
That's a great question. So I have sort of a chart where we're going to see, you know, a yield sort of calculation and whatnot. But yeah, I mean, there's a lot of different ways to do this. So it largely is going to depend on, you know, if you're looking at sort of a, you know, an easy, you know, there's traditional debt and equity, opportunity zone equity in a project, then you know, you may have a sponsor, a fund sponsor, and you know, development partner that you know sort of pull off something like 20% or so of the sort of back end for you know putting sweat equity in, and they get fees and things like that. But for the fund itself and for allocations to the fund could, you know, there could be preferred returns and things of that nature. So it really depends. I mean, you can set these things up a number of different ways. It depends on what the yield requirements are for the fund, you know, and everything else. But they can go from being incredibly simple, and I have some really large funds that are fairly simple. You know, the fund sponsor pulls some of their return from fees, and then they sort of get this 20% back end split. You know, and the developer gets, you know, development fees and things of that nature and incentive fees, sort of like a LIHTC project. And then they get sort of a back end split of the lower tier project as well. But it's really important to understand, and I think you had mentioned this before, Christopher, but that this is a cash-based incentive. So you can't, what you said is 100% correct. You cannot turn a bad project good with this incentive. And this incentive is not like a tax credit where tax credits are allocated to the investors as long as you're sort of compliant with, you know, with what you're supposed to be doing. And you may have a project that's not cash flowing and it's just not doing all that great. Hopefully you're not having to put a ton of cash in, but you're still sort of allocating credits and that investor is still able to get their return. In this sort of situation, that's not the case. Investor has to be able to cash out at the end of that sort of 10-year period, and within the 10-year period, really. You know, I mean, you might do, you know, cash out refi and things of that nature. So I think that's important to understand. But the way, the mechanism of how the investor gets to its return can take, you know, a number of different forms. Did that answer your question at all? I don't know if that answered the question.
It does.
Okay.
It basically, it depends on the deal and returns and structure. So I get it. One other question. You mentioned funds were looking for deals in Pennsylvania and that you had that on your site. Can you let us know what your site is?
Yeah, so I would check out, number one, check out www.novoco.com. So that's our website, and we have, here, let me just share my screen actually. Can you guys still see, you guys can see my screen, okay.
I'll say
So here,
we'll also put the link in the chat while you're showing us, Brent, so that folks have access to it. Yeah.
Great. And so we have, you know, a lot of good resources here actually. So definitely check that out. And we have a fun listing here. There's a lot of other good companies that are doing this. So if I just type, you know, type Opportunity DB will pop up. Probably, yeah. So that's another great great resource here. Check that out, and it will tell you sort of what funds there are out there, where they're investing, and things of that nature. How much, you know, is being invested, and sort of like ours as well, what they're investing in. And they'll tell you actually by state as well. So I think you can sort this by state. So there's a lot of stuff going on, and I think when I did check that I think that's how I sort of, yeah, I knew about TPP before, but I, you know, was reminded about TPP when I sort of went onto the Opportunity DB website, and so that's in, you know, Philadelphia. But there's a lot of funds out there that are seeking assets, is the moral of the story. And you know, I think as long as you're able to sort of communicate with the funds effectively, you know, and pair them up or help to sort of pair them up with the right development partners, then that's the critical component, because a lot of these funds, you know, they're looking for that investment. I mean, there's two ways you can go about this. You can set up the fund yourself and set up the business and solicit investors, which is incredibly complicated, obviously, and you have all types of issues there that you sort of you enter into legally. Or, you know, you solicit the funds that are doing work out there already, and for investment into, you know, and partner them up with these development alliances that you might have within the community.
All right. Thank you, Brent. Any other questions for Brent from the audience? Okay. In that case, we will move on to the next section, where we're going to take a closer look at OZ capital stacks. So Brent's going to run us through that, and then we'll stop again to take audience questions.
Okay, so the investor market, and I think Chris, I think, talked about the $6 to $8 trillion out there, which you know, was a real exciting number that, you know, was raised when this whole thing sort of started going. You know, most of that is actually individual investors that have you know, capital gains that are sort of locked up, but there's a lot of corporate as well out there. And that number, I think, is kind of, you know, been tossed around, you know, 6.4 trillion, and then 2018, 6.8 trillion. And who knows what it is in 19 and 20. We had a huge capital event, you know, in 2020. So, you know, a lot of stock was sold. So there's a lot of gains out there right now in particular. So I think we're going to see a lot of investment, especially, you know, this year and then, you know, into next year. What's the market cap? So, you know, obviously in 2017 there wasn't one. 2018 it kind of went from, you know, 125 billion, and, you know, it's all the way up to, you know, 600 billion or so right now. So so there's just, the moral of the story is there's a lot of investment out there that's seeking quality projects. So it's all about sort of putting those two pieces together. So just a quick sort of example. This is sort of an example of models that that I do. Oops. Well, ignore the name there. I think I accidentally put the name on that, but anyway. So this is like a project that that is a, you know, market rate project that was put together in an opportunity zone. And so this is kind of what investors are looking for to identify what their yield's going to be. And so ultimately, you know, it's a balancing act, right? Because you need to be able to get, if you want the longevity to be there, and you want the development partners sort of stay in this thing and develop this thing over the long term, you know, and operate this thing over the long term, then there has to be a way to sort of exit the investor out of the deal. And so if you have an investor, if you have a loan, I think this one was like a 65% LTV loan to value, and so it had a, you know, big permanent loan, and the rest I think is equity, but from the opportunity zone incentive. But if you're doing that, you sort of have to return a lot of capital. So like, you know, I mean, you have to have a big distribution at the end. And, you know, that really, you know, without selling the project, that becomes fairly infeasible. So you know, it's really kind of about how you sort of layer in the opportunity zone incentive, and maybe it's not, you know, in the entirety of the equity coming in as opportunity zone. Maybe it's a portion of it, you know, some gap, like Chris was talking about, you know, and how do we sort of put these pieces together in the capital stack? And so you know, obviously, you kind of need that, this is a great opportunity for some investment, but it comes down to the numbers as to how much investment you can sort of tolerate and be able to sort of take that investor out at the end of the day. This doesn't show a cash out refi somewhere in the middle, but you could have sort of a cash out refi that helps sort of facilitate some of the return back to the investor, things of that nature. This has a healthy cash return. So I don't know, if you're developing low-income housing, it's not going to have a cash return like this. But this is just kind of an example of what you could see if it was like a market rate. So ultimately, cash is king, and I think that's the moral of this story. You have to return cash to the investor. So that sort of necessitates the sizing of that investment, which means that you have to fill the gaps. You might be able to get a good sized traditional loan, but you may have need for other things like grants and other incentives. So, as a municipality, and you're able to sort of direct and divert some of those, critical grants and critical proceeds to some of these opportunity zone, projects, and that's a big incentive right there. And a lot of communities are doing that, are sort of targeting some of these investments. It looked like on your map, there's a lot of investment. There's a lot of opportunity zone that's sort of along the river, and maybe you have sort of transit-oriented stuff going on. But pairing that all together to sort of fulfill the capital stack is important. Tax credits. So okay, so this is a bigger discussion. So tax credits are complicated when you're talking about low-income housing tax credits in particular. We got real excited about it in the beginning for the possibility of pairing up the low-income housing tax credit with the opportunity zone incentive. And I think some people are still excited about it. It didn't generate as much excitement within the investor community as we'd hoped for, and there's sort of a lot of reasons for that. One of them is that traditional LIHTC investors are, banks, and banks don't necessarily have capital gains, number one. And they're, oftentimes they need that CRA kicker. And that CRA is coming along, and so I think we're going to see that hopefully this qualifies and you get a sort of CRA incentive. So we may see more of those traditional investors in the space, but they're not necessarily paying more per credit if you're trying to find a LIHTC investor that's also going to invest in this opportunity zone. It's also an opportunity zone, so they're going to get this qualification or opportunity zone as well. They're not necessarily going to pay more per credit for that opportunity. It might enable you to solicit more attention, though, and indirectly sort of maybe drive that credit price slightly higher, possibly. There are some funds out there that are doing this, so I think Aegon might have a fund that they're working on where they're trying to sort of put together the opportunity zone incentive with LIHTC. There's some life insurance companies out there that do have big capital gains. They're sort of looking to invest in these as well. And there's a lot of nonprofit, larger sort of nonprofits and community development entities that are also sort of trying to make this happen. Like Bridge, I think, is trying to make this happen. So they're interested in really trying to make LIHTC and opportunity zones work together. But just note that there are sort of difficulties there. And the other issue is that you would think maybe can we bring in sort of a parallel investor into that entity, into the lower tier entity, and have a LIHTC investor, so you have two investors, and the issue becomes with that that the LIHTC investor has to get 99% or 99.9% of losses and depreciation, so they're getting all those credits. So it's possible to do, but what would potentially happen is you would have it would all be on the back end for that opportunity zone investor, and they might have to wait a little bit longer. And so they you could have sort of a flip where they have a larger back end piece. And so you do a refi at the end where they get, they get their sort of back end piece, but ultimately, that takes a sort of patient investor that may be willing to give up some of the return for to do this community-minded investment, which there are out there, but it's just about sort of finding those players. And again, sort of supplementing with local grants and incentives and all that. I'm not gonna rehash that. So I think that, I think that's it for me. Yeah, I talked about the Aegon and all of that. So
Great.
was that it for me?
Thank
Oh
you.
no, that's not it. Okay.
Yeah, we're gonna pause
This is my
here
slide.
for
Okay,
a moment
gotcha.
and just ask the audience if you have any questions for Brent about any of the content that he just presented. I actually had a question, Brent. If you could go back to the model that you put up, I was wondering if you could perhaps, not walk us through the entirety of the model, because I know it's very complex and the like, but the elements and the inputs that are relevant,
Sure.
particularly relevant to the group folks on this call. What are they, and why are they important, and kind of what are the main takeaways for consideration in those elements?
Definitely.
Mm-hmm.
It kind of comes down to, it's distilled down to the three sort of primary benefits of the incentive. And that being number one, the gain deferral. And so what's happening here is you can see in column A, contributions are being made. So this is a yield schedule for the investor. So that's a pull on cash for them. So that's why those are negative. But those are their capital contributions that are coming in. What that's doing is, you can see over in column E, Echo, it's creating a benefit from not having to pay taxes on that. So this is showing, this is an individual in this case. So individual long-term capital rate, 20 plus the 3.8% net investment income tax. So they're getting sort of positive benefit from not paying taxes at that point. Then in column B, you can see there's this sort of annual cash flow that's coming into the investor. What you might see oftentimes is, once this project hits stabilization, you might see a cash out refi somewhere there, year 4 or 5 or something like that, in this whole grand scheme of things, and that will sort of push some of that cash up toward the front. Ultimately, it's sort of a timing difference, because then your annual cash flow sort of goes down, because you have more debt service and whatnot, assuming that the interest rates are fairly the same. And then your residual sort of value is probably lower as well, because you've got this bigger loan. But that moves some of that yield sooner on, or cash sooner in the process, and drives the yield up. Then there's an area for credits. It kind of depends on what you're doing. There's also, I don't think I talked about this at all, but renewable energy. There's a lot of appetite for new renewable energy projects out there. But for certain tax reasons and basis issues, it's not something necessarily that the investors are looking for, because to make an opportunity zone investment, it means that you don't really have basis. I'm not going to get into that too much, but there are sponsors and there are people sort of developing this for their own use out there, or for their own returns, that maybe are able to sort of utilize this and are interested in it. But in any event, there's a lot of tax credits, historic tax credits. Pittsburgh, I'm sure there's a ton of historic projects there, being such an old city. And if you can sort of tap into that, historics make sense with the opportunity zone incentive, because with historics, there's already this sort of flip that's built in after 5 years in the ownership structure. And so with a historic deal, you can sort of get that historic investor effectively out of there after the 5 years, and then you have sort of the remaining 5 years with the opportunity zone investor, and they're meeting their yield and everything else. So So historics sort of work. So you could identify some historics that might work with the opportunity zone incentive. But anyway, there's a lot of room for a tax credit to be filled in, and that's sort of deemed a cash return. So then you get to sort of your total return, and then moving forward, we talked about the deferral benefit. You know, F and G are sort of the taxable income, annual taxable income impact from a cash basis, where in this one there's income. Oftentimes there's going to be depreciation that creates losses, but in this case there's income. To get to total sort of benefits, and then there's a tax payment at 2026. So this is where the second benefit comes in, which is the elimination of part of the gain. And what happens is, in this case, $9.2 million was contributed, and part of that happened in 2019, which that portion got this sort of 15% elimination of gain. And then the 2020 and 2021 installments got 10% of their gain eliminated. So when you get to this tax payment at 20, and you can see those numbers all the way in column O there, but when you get to this tax payment in 2026, that payment would be larger if not for that gain elimination. So that's the second benefit. And then finally, the third benefit is sort of trying to, and so that gets you to your sort of total return for the opportunity zone investment, which is 13.8. And the only way, and the best way I think to sort of, compare and contrast that benefit with, what a regular investment would be, is to sort of run the same model with a regular investment without those sort of benefits. And then what we see is there's this big tax payment in column L at the bottom for the non-opportunity zone investor, which is why their return ends up being 11% as opposed to like 14%. So that's kind of what this is doing. It's in short, it's sort of trying to sort of define what the three benefits are. I don't know if that helps. You're on mute.
Sorry. Yeah, that's great. Thank you. And could you, I know, what kind of did you mention what kind of project this is, the analysis for?
Yeah, this is a market rate affordable house. I think this is sorry, not affordable housing. It's a market rate housing project. Mm-hmm. So and I think there is I think it was mixed use. I think there's some commercial in it as well. So if there's an affordable piece to it, then obviously your cash yield will go down. But that also potentially means that you're so that means that the impact of the opportunity zone incentive may actually have a sort of larger impact on the overall yield, but your cash yield would probably be much lower, maybe 8 or 9 or something like that, if that. But it depends. It depends. You can do sort of 80-20 deals. You can do things like that. Where in an 80-20 deal, you have an opportunity. You have a LIHTC investor or a low-income housing tax credit investor that's sort of invested in 20% of the deal, and 20% is the minimum sort of set aside that you have to have established in order to make a project eligible for the low-income housing tax credit. And they sort of own a piece of this separately through a lease, and then at the end of the investment period, the lease is sort of released for a de minimis amount. But that helps finance a good portion of it. And then you could have, the remaining portion be subsidized with, largely with, opportunity zone investment. Obviously there'd be a big, loan on that as well, or, tax-exempt bonds and things like that. But there's a lot of different ways to do this.
Yeah, great. Yeah, I think that's helpful to kind of see how it plays out over the long term and how it looks differently in different types of projects. So thank you for that. Does anyone have any questions that have come to mind as Brent's been walking through the model? All right. Well, in that case, I think, Brent, we will give you a reprieve and turn things over to Michael. Thank you very much. This has been incredibly helpful. And I'll turn it over to Michael to kind of talk more about so now that we have all of this information, what can the city do to kind of fill in the blanks in these models and close OZ project gaps. So Michael.
Yeah, I want to start off by referencing actually what I think is a pretty good book by Katz and Nowak at Brookings Institute called The New Localism. The whole point of the book was about how effectively we need to stop thinking about the federal government at the local level coming in and swooping in and saving the day with various programs. Now, OZ is a federal program, to be clear, but it works on the tax side. And localities, through various structures and incentives and things like business improvement districts or collaboratives and innovation districts and so on, need to come through to be the way forward of how it is that we can revitalize our cities and communities. And I actually really buy into their thesis for the most part on that, and think it's an important part of how we look at economics and particularly agglomeration economies. So we have this program then called opportunity zones. And well, already the opportunity zones, as you see, are directed towards a certain criteria, areas of need or areas adjacent to areas of need and so on. Those are already set. We're not changing them any second right now. Your governors set that a while ago, a few years ago. On top of that, there's all sorts of zones. I've written a small paper on this for one of my doctoral courses called, I ended up calling it Game of Zones, because we've been through this for a long time with lots of zones, whether they were enterprise zones and hope zones and all these different zones that we always have. Now we're at opportunity. And those things overlay or they do not overlay. Sometimes they do and sometimes they don't. So one of the suggestions that's urged about localities and states to do with the opportunity zones is, number one, to the best that you can, layer any geographic type place-based, we call these place-based programs, right? Programs that are eligible by a certain place, with the opportunity zones as best as we can. There's a lot of programs out there that have all sorts of other criteria, man, industrial districts, or that there's something rural preservation, or that there's, and you have all these maps here and there that make one eligible for some state or county or local incentive, and they don't necessarily match the OZ. So one of the suggestions is that these ought to align very much on that, because the layering of these programs, it's not about the investor themselves. It can target the investor and it can target the business. You could go there, but it's about targeting more broadly the place. As we've talked about here, a lot of the way the opportunity zone mechanism works is you have a tax incentive that very much goes to the individual funding the capital, seeding the capital for some sort of a project through equity and the tax benefits thereof. Business owners don't receive directly the funds. They receive ideally access to capital. We talked about that, right? So if I own a bakery and I'm in an opportunity zone, I don't get opportunity zone money per se. I get access to capital if somebody wants to buy equity investment in my bakery. So that's what that works. But the idea that I'm going with is, look, we know that the vast majority of this program, or the opportunity zone program, is going to go to real estate. And I think anecdotal evidence and whoever's trying to start calculating the actual evidence starts showing that most of the money is going to real estate and redevelopment ventures in one way or another. We would like money to go to Maria's Bakery. I always use Maria, that's the name of my mother. Maria's Bakery over in an opportunity zone so that she could fund a bakery, but this isn't set for that. But your local and state incentives might. I don't know Pennsylvania, it's the whole host of incentives of one state or your county, but I'm pretty sure that there's all sorts of things that can align towards the actual small business owner themselves. On the second hand, there's also the individuals who live in the areas, whether we're talking about now the tenants, renters, tenants, and homeowners as well. If we want to revitalize an opportunity zone, it's not about just bringing in the capital that develops the real estate. That's one part of it. The other development that happens around it, which is thriving communities by people having access to capital to retain their homes, to live in their communities, to afford the new developments, number one, on affordable housing, and to not be displaced. Those are important programs to, again, layer on top of the maps. And I keep saying this because I want to stress again, the map. There's a map. We're obsessed with this map. Everyone's always looking at the map. People ask us, can you show me the map? And we can show you the map, and you've seen the map. This is, you have a very important policy map. I don't think there's been one from the federal government with so much emphasis on a specific map for every community as this one is, as I can recall. So we have this. Have your other maps layer that, affordable housing, and your programs towards small businesses, the actual businesses themselves that we can incentivize, and the homeowners. That's how you leverage a program that's predicated on leverage. So it's going to be a lot of tax break going towards investors that can invest in businesses in a community, and primarily real estate ventures. Let's leverage other things on top of that, but we have to make sure that the investment's aligned. And if that makes sense, that's kind of really my biggest thing about the equities, because you have a lot of programs in your communities that are based on equity, but are we looking at it to make sure that it's forcefully multiplying the opportunity zone program, instead of a mishmash of programs here and there that don't necessarily line up on the map? And the best we can do there is the best way that this program can really be successful for your community. And it's especially when it comes to the equity concerns as well. I think that's the best that I can speak to that. I'm happy to chat and have any questions on that.
Thanks, Michael. Any responses or questions for Michael about anything he's just gone through?
Michael, it's Christopher here. Hopefully my audio is working. You know, one of the things that you did bring up is the difficulty of the funds and operating businesses. Based on the market research you have seen, particularly around urban retail and the fact that there's pent up demand for urban retail, what suggestions or recommendation you would give either to the city or to a fund manager, recognizing that COVID-19 is changing the game, recognizing the impediments that is in the tax incentive, but how could we meet the demand for urban retail in some of these opportunity zones?
Well, yeah, so when it's urban retail with opportunity zone, especially if it's a real estate venture, it comes down to how that venture is structured in the retail, right? So we're talking about the retail component of usually probably a mixed use program. And we need that retail component to thrive, right? And that retail component thriving is, well, it's gonna bring the investment or not, because if we're out of retail, if retail is dead, I don't think it's dead, then there's gonna cause a bit of a problem. So what can we do then? In one hand, again, incentivize, it's just enough. More programs that actually go to the operating companies, to those businesses that are in the areas themselves, or further incentivize the landlords and owners to have a certain type of a mix of retail or subsidies for their retail component, because that's very critical to placemaking. So some things that can happen, for example, there's a mechanism whereby in the opportunity zone, and we checked this out when I was at CBRE, a landlord can technically offer in some sort of a program of equity in lieu of rent towards an operating business on the first floor. and that being part of the opportunity zone investment. So they can actually use their investment as a structure to invest in the operating company. Now they own a piece of the operating company that lives in their building. That's technically possible, and it's not unheard of. Malls, shopping malls used to do this in various sorts, have some sort of a joint ventureship with their own tenants. So it's something that exists out there. But the operating companies, especially the retail, need to thrive for these mixed-use projects and walkable areas, especially to continue. And it's a challenge in an era right now we're facing it. Hopefully, we're going to be on the other side of this. But I think it's having those landlords really treat the retail in a special way that, frankly, in my opinion, from a placemaking perspective, the retail and the multifamily is a little higher and a higher of placemaking.
Yeah, I generally get the sense that the urban retail model has to be direct connected to multifamily demand, because it's just COVID-19 just revealed that there's not enough housing in these corridors, and so appreciate that.
Yep.
Any other questions for Michael or Brent? I don't know if anyone from the URA has any final thoughts, James or Tom.
Well, I mean, I appreciate the presentation and the information. I think it was helpful to me. I mean, I'll just be frank. The thing that I saw opportunity, I think there's a steep learning curve. I think the last question actually on small business support, like we get inquiries, from time to time from small businesses asking, how does opportunity zone help me? And frankly, it's a difficult question to answer because it's not, understanding it essentially can be a incentive to attract equity. At least in my experience, the truth matters with when you're talking about very small, neighborhood businesses, it's hard to imagine, it's hard, that conversation seems to be a difficult one, and how to navigate that and what resources really to send folks is challenging. I think on the real estate side though, this was helpful to me. And I know there's several folks on here who are doing deals in opportunity zones and gain some value here. To how from a structure perspective, opportunity zone incentive can potentially help a deal. I think, for me, and it's an important sort of baseline takeaway is that opportunity zones operate differently than, say, historic tax credits, other federal tax credit programs where the economic return is tied to essentially what's a compliance issue, right? So with historic tax credits, are you complying with the National Park Service and rehabilitating an historic building and keeping that up during the tax credit period? New markets tax credits, are you complying with the rules of new markets to get the economic benefit of the tax credit? The economic return on the real estate itself is less important, frankly, to that tax credit investor, other than, you don't want to be invested in bad deals, but generally speaking, your economic return isn't tied to that. Whereas opportunity zone, it very much is. Like the opportunity zone investor, while it's an incentive to put their capital into projects that are in opportunity zones, their economic return is very much tied to the economic success of the project. And that's a fundamental difference. And that has to be, developers doing deals on the public side, how we look at deals and how to navigate, the opportunity zones in that sort of context is important. But anyway, but I really appreciate it. I hope folks here got a lot out of this, but I want to mute myself and let James talk and others jump in as they wish. So thank you.
Yeah, and
Hey, Tully, can we ask Brett to answer that actually? Brett, have you seen, to Tom's point about the small business, have we seen any new market tax transactions being blended with OZ transactions at all?
Yeah, there are people that are putting them together. I haven't been involved with any, but I don't do a ton of new market stuff. But I know that is a focus. We have a bunch of guys at our firm that do opportunity zone deals and new markets, and a lot of these CDEs and all of that really, want to get into the space. So I think there are deals being done. I don't know to what volume. You know, some things pair better than others. You know, like you know, the historic might pair. That I have done a couple of deals there, even though I don't do a lot of historic. So that sort of works depending on how you structure. It gets complicated. But yeah, I mean, you know, you can make a opportunity zone deal work. I mean, a new market deal work because you have this sort of loan between the parties, right? So you could have the Qualica B that's sort of owned under this opportunity zone structure, or the CDE is making a loan then to the Qualica B and all of that. So I think it is a pretty decent fit. Also, the 7-year, 10-year sort of outcome is a pretty good sort of alignment as well. But I think what Michael was saying is so true. Like that, you know, it's hard to make some of these operating. If we're just talking about operating businesses, it's hard to make some of these operating businesses work, especially now. So it depends on, you know, what type of sort of operating business we're talking about. And I think that becomes very granular and specific in its discussion.
I'll just give a quick, I know, James, I think you want to say something. Our next roundtable, which is going to take place on December 11th, so in a few weeks' time, is going to be focused exclusively on the business side of on OZ operating businesses and how the incentive works, and then how we can work on business development in this realm. So more to come on this topic. I think it's certainly a great jumping off point, but I just wanted to give folks that awareness that is going to be a topic we dive much more into in subsequent roundtables.
Oh, one more quick thing too on that. There are like incubators out there that you can look at for this operating business sort of concept. One of them is Sola Impact. They have like a beehive, I think they're doing in Los Angeles or something. So anyway, check that out if you're interested. Ways to make that.
Yeah, thank you for Brady. I was thinking about that too earlier. But then to Tom's point earlier, it's like those business incubators, those businesses are tied to the real estate, right?
Yeah,
It's
exactly.
like they're basically tenants who are paying, you know, rent. So
that's right.
I think that's kind of like the soft sweet spot for businesses that can potentially pay for space. But I think beyond like your traditional fast growth or cash rich, you know, startup businesses, it's hard to see on the minority legacy businesses side, like the example that Michael gave, existing baker, right? Unless they're ready to go franchise, it's hard to think about making that work. But definitely something we're going to be monitoring moving forward.
I see a few mics turned on. I'm not sure who wants to jump in. I'll go to James.
Yeah, I'll just add, you know, one of the takeaways from me is just that really being able to utilize this particular incentive for that mission-based, you know, desire that we all have really is going to ultimately require a lot of us collaborating across our different sectors of Pittsburgh. You know, at the URA, when we're going through projects, there are a number of funding tools that we have that are available, and to the extent that they can pair with OZs in a project, I think that's great. And you know, being able to advance that would be awesome. But I think where there's going to be the biggest need really is for those sources of OZ investors that are interested in more of the mission-oriented, just given the nature of the projects that a lot of folks on this roundtable are involved with. And so, you know, to that, I just want to say, you know, we need to advance this through that sort of ecosystem mindset where we're trying to build connections and networks and partnerships, knowing that, you know, moving forward, we can all, you know, chip in some way, and hopefully through the multitude of connections that we have, you know, really attract some good investments into these projects.
Can I add one more thing? Maybe I was thinking, and when you mentioned incubators and accelerators, I'm wondering if for the next as we think about maybe it's one of the next roundtables, I'd be interested, either whether it's through the roundtables or separately, like a case study and how, because I've read about, sort of incubator and accelerator programs that have, or not programs, but projects and co-working, that seem to be benefiting from OZ. That's sort of then, is the benefit then to businesses. You can take advantage of these, these programs and this real estate. And so in Pittsburgh, I mean, there's a number of accelerator programs, and we talk in different areas. And I'm wondering if that's something to kind of hone in on a little bit as sort of a niche sort of product that has been able to use OZ to its benefit, to start to think about how that might be something that could be applied here. So just a thought.
Yeah, we can certainly incorporate that, Tom, into future roundtables. I think Good Fit might be the next one, so we'll try to make include that there. Anyone else? I know we're about out of time. A few minutes left. Derek, I see you wanted to jump in.
Yes. So kind of picking up on a comment James and Tom made, my challenge has been, we hear about all these funds, and kind of in the world of OZ, but really finding them that are in alignment with, with the mission. As it was said, when you're doing affordable housing, whether it's a mixed income deal or straight affordable housing, it's a much different motivation for an OZ investor and a LIHTC investor. So I know you sent that list out, Brent, and I think I heard Tom say that the URA is focused on trying to bring in impact investors, but do either of you all know any OZ investors that are actually doing these kinds of deals where they are marrying the two? Because I'm really just trying to sift through to find the ones that are in alignment, because there's not too many of them. We've been our challenge.
Yeah, so I mean, there aren't a ton of there are some nonprofit sort of entities that are trying to do some of these deals with their own proceeds and own funds, like Bridge and some of these other entities. From a traditional investor standpoint, you've got some life insurance companies that are sort of trying to make these deals work, and syndicators that work with these life insurance companies. And again, I think Aegon was one that I found that they're trying to put a fund together, but there's not a ton of them, to be honest, because of the sort of additional compliance, number one, and then I guess the perceived economic return isn't necessarily there for them. So it really depends, but they are out there. It's just you kind of have to find them, and maybe we'll see more of that, hopefully, as CRA sort of develops in this space. That's in the process of sort of being approved for use on opportunity zone investments. So that could be very big, and if that happens, then I think we'll see a lot more traditional investors in that space that are looking for opportunities / LIHTC investments.
Yeah. Is that helpful, Derek, or should we?
Somewhat.
Yeah, Derek needs an investor. We got to help. When we find you one, we'll have to match. I don't know. I mean, it's candidly, my learning curve is, I don't have a Rolodex of OZ investors I'm trying to match with deals. I mean, that's something, hopefully, that starts to be something we can build at some point. And frankly, one of you smart developers that goes out there and gets a deal done with OZ, it might, that'll be an interesting case study for us.
Hey, Derek.
You have one, right? You actually have a case study for us. Sorry, go ahead, Lance.
No, that's all right. And Derek, for what it's worth, I don't know if you know this, we're trying to do it the other way, where on AlleghenyOpportunityZones.com, we've got projects looking for investors instead of investors looking for projects, right? So the real secret sauce is whoever can figure out how to link those two things up, then you got something. But we figured if looking, we're gonna make that information available. So without give me the details of the project, and we'll get it up there.
And just to, one of the things I just land, I know we're at time. One of the value adds of having the Locust Network to be a part of this conversation is that we do have over 300 real estate developers and investors who are triple bottom line investors who are doing these, and we're literally struggling to make low-income housing tax credit, new markets, historic. You know, we work very closely with HRI and a number of others who are using these tax incentives. So our goal and our hope is that after we go through these discussions with the city, with URA, to identify not only the strategy, but the projects, then we'll be able to bring the investors who are mission aligned and really sit at the table to help figure out and move these projects forward. So we're definitely looking forward to bringing that aspect. But before we put the horse before the cart, we want to make sure we have the strategy and then the projects on that, because I think it's many ways we want to make sure we have a mission alignment amongst those who are on the call before we start bringing outsiders in to figure out how do we make the deal close. So they're out there, and definitely, Derek, if you want to talk to Tola and I offline, if you have a specific project that you're thinking about, we definitely can try to start some of those conversations early on. But again, thank you all. This has been a great discussion.
Yeah, so with that, I just wanted to quickly, I know we're 2 minutes over. I wanted to thank Brent and Michael and Christopher for their presentations and for fielding questions and the like, to James and Tom for bringing this group together. And we're looking forward to doing it again on December 11th. Just a few quick housekeeping things. We have been recording this presentation, so we will make the recording, the slide deck, and our notes available to folks so that you have those as a resource. And you'll be hearing from us with more specifics on the agenda, date, time, participation info for our roundtable on December 11th, which is a Friday, talking about the businesses more specifically. So we look forward to seeing folks on that call. And with that, I guess happy holidays. I hope everyone is safe and able to enjoy with family and friends, either in person or at distance. But please take care, and we will see you soon.
Thank you very much. James, thank you. I know you put a ton of work into this, so thanks, James.
Thanks, everybody.
Thanks, everyone. Okay, take care.
Thank you.